Imagine a friend invites you to a fun coin toss game. You pay 100 rupees to join. If it's heads, you win 200 rupees. If it's tails, you lose your entry fee. You can play as often as you like. Would you give it a try? This is a simple example of a risk-reward trade-off. Risk is the uncertainty involved. In this case, the chance of losing 100 rupees if the coin lands tails. If it lands heads, you win 200 rupees, resulting in 100 rupees profit. This is the reward. This concept of risk-reward ratio is crucial in financial markets and investing for making sound decisions. However, it involves more variables and is far more complex than a simple coin toss. There are several ways to measure an asset's risks. Few of them are standard deviation, that shows how much an asset's returns fluctuate over time. Beta, which indicates an asset's sensitivity to market movements. And alpha, that measures performance compared to a benchmark adjusted for risk. By far, standard deviation is the most common. On the other hand, reward refers to the expected returns estimated through fundamental or technical analysis or valuation models. Expected returns could be measured through CAGR, which is compound annual growth rate, reflects the average annual growth rate of an investment over time. XIRR, that is extended internal rate of return, which is ideal to capture returns for irregular cash flows. And absolute return, that shows the total gain or loss over a specific period. In the stock market, risk and returns are positively correlated. Generally, higher risk means greater return potential. Now the question arises, what is the ideal risk-reward ratio? There isn't a one-size-fits-all answer. An investor's risk profile, considering factors like financial standing, preferences and goals, determines the appropriate risk-reward ratio to aim for. Let us understand this better with a risk and reward matrix that shows how different investments compare. Investments which have low risk generally have low reward and are safer investment options. On the other hand, investments with higher risk have the potential to generate high rewards and the risk involved of losing capital is higher. Be cautious of schemes promising high rewards with low risks. They are often too good to be true. And lastly, taking high risks for low rewards does not make sense. Based on their risk profiles, investors can choose from different options. Aggressive investors may prefer equities for a high risk-return ratio, while fixed deposits, gilt-edged funds may be an ideal option for conservative investors. Other assets like fixed income securities, gold and commodities fall somewhere in between. Additionally, mutual funds can provide more tailored solutions for various risk profiles. Another important factor in determining the risk-return ratio is the investor's age, specifically the investment tenure. As tenure typically shortens with age, the risk profile should become more conservative. A common rule of thumb is 100 minus age to guide asset allocation between risky and safer investments like equity and debt. For instance, a 30-year-old might invest 70% in equity, while a 60-year-old might allocate only 40% to equity. The risk-reward trade-off is central to every investment portfolio. Understanding this ratio helps investors set realistic expectations and achieve favorable outcomes. So aim to get the right balance of risk-reward to create a portfolio that can cruise through market waves and help you reach your desired destination.
So much good, Investify.